The market's giving us conflicting signals, so we're going to cut through that noise and build a clear plan for the next 1 to 2 weeks.
So what's the big puzzle here? Well, the index is sitting near highs, which looks great on the surface. But when you look under the hood, man, the internals are screaming danger. We're talking about some of the biggest red flags in years. We absolutely have to figure out what this split means.
All right, first things first, let's look at the news. You know, most of it is just noise, right? It's designed to shake you out. We're going to find the real signal.
So, what's the noise? You've got the usual stuff. A potential government shutdown, this temporary trade truce with China, which, let's be honest, looks like a classic sell the news setup. And of course, the Fed being the Fed. But the signal is how the market is actually reacting. And it's being incredibly picky. That tells me these headlines are just making things fragile, not building any real strength.
Okay, enough with the headlines. Let's get to the data that actually matters. Because, despite the S&P looking good, the tape is telling a completely different story. We're seeing some serious cracks in the foundation here.
Just check out these numbers from the other day. The S&P 500 actually closed positive. But get this, for every single stock that went up, almost 4 went down. That is terrible market breadth. It's a classic sign of trouble. You've got the generals, the big guys, marching forward, but all the troops are running the other way.
And I want to be clear, this wasn't just some random weekday. This was a historical outlier. We're talking about the worst breadth day in history for a day the market closed up. When you see a few mega caps literally pulling the entire index positive while everything else is bleeding out, well, that's the textbook definition of a sick, top-heavy market.
And that brings us to the big one, the Hindenburg Omen. Yep, it just triggered. Now, for those of you who don't know, this is a technical indicator that looks for a very specific and, frankly, weird set of conditions. It's basically when you see a lot of stocks hitting new 52-week highs and a lot of stocks hitting new 52-week lows at the same time. It's a sign of a deeply divided, fractured market, and it often signals a higher chance of a crash. Now look, no indicator is perfect, right? Nothing is a crystal ball. But this one has a track record you just can't ignore. The last 30 times it flashed, the S&P 500 fell within 2 months 83% of the time. Let that sink in, an 83% hit rate. So when you combine that with the terrible market breadth we're seeing, the bearish case gets a whole lot stronger.
Okay, so if the average stock is getting hammered, where is the money actually going, right? It has to be going somewhere. And the answer shows us that we're in a hyper-concentrated, theme-driven market.
Just look at the difference here. The QQQ, it's up about 19% for the year. Not bad, but that's nothing compared to the real pockets of strength. XNTK, which is a basket of concentrated AI names, is up 39%. And then you have XAR, the Defense and Aerospace ETF, up a whopping 46%. This makes it crystal clear. This isn't a buy-the-market kind of rally. The momentum is in very, very specific places.
And it's pretty obvious why these are working. XAR is just riding the wave of geopolitical tension and huge government defense contracts. Meanwhile, XNTK is basically your pure-play bet on the AI hype train. It holds all the big names driving that story. The money is flowing into these very specific narratives, not the broad market. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
All right, so with all that in mind, let's turn this analysis into an actual game plan. The market's at a fork in the road, for sure. We need to map out the different ways this could play out.
Basically, it boils down to 2 main scenarios. The bull case, it's all about the mega caps. Their earnings have to be good enough to drag the rest of the market up with them. The bear case says no way. The bad breath and that Hindenburg Omen, that's the real story, and a pullback is coming. So let's look at the triggers for both.
So the bull thesis is pretty simple. It's the general save-the-day theory. If a giant like Amazon comes out with great earnings and solid guidance, it could just calm everyone down. That would suggest all this recent chop was just a sell-the-news overreaction, and that the Hindenburg Omen was a false alarm. If that happens, the market probably just keeps grinding higher, led by those same handful of stocks.
Okay, now for the bear thesis. This is the idea that, gravity finally kicks in. The terrible internals and the Hindenburg signal aren't a fluke, they're the real warning. What happens is the market leaders finally stumble, and the concerns we saw with a stock like Meta about the insane amount of money they're spending on AI start to spread. Investors start to wonder if growth at any price is really a good idea, and that's what triggers a wider market correction.
Okay, so we've got these 2 very different potential paths. how do we set up trades to play them, but, and this is key, with defined risk?
If you're leaning bullish, you don't fight the tape. You follow the clear momentum. Right now, that's in defense. Using a call debit spread on XAR makes sense. It lets you get long, but it caps your max loss, which is just smart money management when the rest of the market is so shaky. What kills this trade? A sudden change in the geopolitical climate or a big cut to the defense budget.
Now, if you're leaning bearish, you hunt for weakness. Look for stocks that are already lagging. A name like SoFi could be a candidate. A long put or a put spread gives you a defined risk way to play for a breakdown. The plan is simple. If the market weakness continues, this kind of stock should underperform. Your invalidation level's clear too. If it manages to get back above that 28.85 support level, the thesis is busted. Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.
So that leaves us with the million-dollar question for the next couple of weeks, right? With the guts of the market looking this historically weak, does it really make sense to chase the last few stocks that are still working? Or is that just, picking up pennies in front of a steamroller? That's the decision every trader has to make right now.